So one of the most common questions and inquiries I get as a mortgage broker is people looking to access their home equity from a home equity line of credit or a home equity loan. And most people think it is the same thing. It is not. In this video, I want to break down what is a HELOC, which is a home equity line of credit, and what is home equity loans. These two are separate things. Now, both of these things help you access your home equity, but both of them have different processes, different costs, and different reasons why they're most popular. Now, typically, whenever people call us to access their home equity, it is either for using it to consolidate debt, some of them just want to have it for emergency purposes, or they want to use it to invest in other assets or other projects. Or number four is they have an ongoing project like home renovation, something else, and they want to have the money just in case to be able to use whenever they need. So let me first go down to a HELOC. What is a HELOC? So a home equity line of credit essentially is kind of like a credit card on your home equity, which you can use anytime, and you only have to make interest only payments on that. Now, let me give you a specific example. If you have a home worth $1 million and your first mortgage with a bank is 500,000 and you get another 100,000 in a HELOC, now this 100,000 will be part of your bank account with the bank. You can access it anytime. You can take the money off, pay it off anytime, so there's no penalties, fully open. And if you have used it, typically you only have to make interest only payments. Now, typically HELOCs are only offered by financial institutions such as your bank. In Canada, the most common rate for a HELOC is prime plus 0.5%, and these are typically variable. So as prime goes up or down, the rate keeps on changing. As of making this video in February 2025, the prime rate is sitting at 5.2%. So the most common HELOC rate you'll find is 5.7. Now, if you had to borrow 100,000 on your HELOC at prime plus half today, that would mean approximately 475 in monthly interest only payments. The good things about a HELOC are A, you can use it anytime. You have a lot of flexibility, and they're good for cash flow because you have to make interest only payments. And the other part is you have a lot of flexibility in how you can use it. I have seen some investors have it and use it for investments. And because they're borrowing money, a lot of times they're also able to write off the interest part if they're trying to make a business investment. Now, the downside of a home equity line of credit is because they're only offered by banks, you have to go through the thorough process of income verification, giving all your income documents, credit score, all that stuff. So if you don't have good enough income or credit or typical way of declaring your income, this may not be an option for you. But of course, there are always exceptions. Now, let's shift to something known as a home equity loan. Typically, a home equity loan means a second mortgage. Now, these are essentially private mortgages where you can either get an interest-only loan if you want, or you can get it amortized over 10, 15, 20, 25 years to make sure you are paying principal as well. Now, again, what we see most people who come for a home equity loan are using this money for emergency or miscellaneous family reasons, debt consolidation, home improvements, or for their business. The big difference in these is these are not typically based on your credit and income, but they are mostly based on the amount of equity available. For both HELOCs and home equity loan, most financial institutions or private lenders typically like going up to 75 or 80% of your value. So if your house is worth $1 million and you have a first mortgage of 500,000, typically you won't get a home equity loan or a HELOC more than 250 or 300,000, which brings you to approximately 75 or 80% of the value. Now, one big thing with home equity loans is because these are private lenders, they could be really accredited financial companies or mortgage investment corporations. Their rates are always higher than that of a bank. But because their rates higher, they are able to offer these products for you without a lot of diligence on your income and credit score. The other part of this is these are not revolving. So like a line of credit, you can withdraw it anytime, put it back, withdraw it, put it back. A lot of these times in a home equity loan, you get the money in a lump sum and then you make regular monthly payments on it, which in most cases is interest only. Now, if you had to borrow 100,000 in a home equity line of credit at a rate of around 9.5%, you would pay approximately $792 a month in interest only payments. Of course, you can get an amortized option, but this is the standard there. Now, some big things, the pros and cons of using a home equity loan are as follows. So pros, it's fast, no nonsense product and based on your equity. So even if you have a bad credit or unprovable income, you can still access it. The third thing, a lot of flexibility. It is not limited, so you can access it regardless of where your first mortgage is from. You might be able to go to a different mortgage broker or a lender and get this product. The downside is it is always more expensive than a home equity line of credit. There may be some exceptions, but on most cases, this is always higher rate. And you also have to pay other costs like a lender and broker fees, or maybe a cost to do an appraisal and legal fees in these products. But when you need to access that equity and a bank option is not available, this is the second best option or an alternative. So hope those two things got you clarity and made this financing slightly easier. If you are looking for anything about a HELOC home equity or want to know what's the best and cheapest way for you to access your home equity, make sure you contact us with our information below or give us a call.